Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, comment on this podcast, and find links and other information related to today's conversation. You'll also find our archives where you can listen to every episode we've ever done going back to 2006. Our email address is mail@econtalk.org. We'd love to hear from you. Today is November 1st, 2018, and my guest is Anat Admati, the George G.C. Parker Professor of Finance and Economics at Stanford University's Graduate School of Business, where she is also director of the Corporations and Society Initiative. This is her third appearance on EconTalk. She was here most recently to discuss bank regulation in April of 2013. Anat, welcome back to EconTalk.
Thank you.
Our topic for today is the financial crisis of 2008. We're in the 10th year anniversary of that. And we're also going to get into, I hope, the role of the financial sector in general, and I hope also some corporate governance issues. I want to start with what you've learned personally from that crisis, if anything. As some people have said, there was nothing new there. I wasn't surprised. I didn't learn anything that I didn't already know. That isn't true for me. I'll talk in a minute perhaps about what I've learned, but I'm curious what you're in finance. So what did that experience either get you to reconsider or get you to learn about that you didn't know about before?
Oh, I mean, it changed my life. I mean, it taught me so much. I can no longer be what I was a decade ago.
What was that?
It awoke me. Well, I mean, I basically realized I lived in a sheltered bubble that involved many, many false assumptions. I was working on the wrong set of problems, not on the problems that matter. I was uninvolved in policy, and that changed. So everything, from my teaching to my research to my activities professionally, everything has changed about my career trajectory. I'm still a professor at Stanford, but I talk to different set of people. I think about different set of problems, related, but, and as an economist, but now with them much out of my silo.
So the bubble you mentioned, what was the nature of that, and what had to be reevaluated once you saw what had happened?
Well, I mean, in one word, assumptions, implicit assumptions, things we take for granted. I just didn't know so many of them were wrong. Assumptions about markets, assumptions about financial market and the financial sector, assumptions about politics, assumptions about people, and sort of almost this sociology, even ethics of people, all kinds of things like that.
So give us some examples of what you believed beforehand that you no longer think are true.
Well, I mean, in research 10 years ago, you'd find me, the topic I was interested in was already corporate governance. And there, the problem that economists and law and economics people obsess over is entirely the problem of how of the sort of manager-shareholder conflict, because clearly we believe the purpose of corporations is to, in the Milton Friedman language, make as much money as possible, subject to the rules and ethics, he adds. And in the way we teach it in corporate finance, to basically maximize the stock price. And that's what I've been teaching in corporate finance class. And so the only issue is, you have dispersed shareholders, and especially in a public company, how do they monitor managers, those kinds of things, activist shareholders. So I wrote a paper with Paul Fleiter about large shareholder activism. We've written a couple of papers on that. The free rider problem of monitoring, things of this sort, voting. I had students working on corporate governance. And I never also looked at financial institutions as corporations. It was very general. And I realized that when you say that the purpose of the corporations is to maximize stock price or make as much money as possible, or however you frame that purpose, there are implicit assumptions there that are just false in reality, and certainly false in the reality of financial institutions. For example, implicit assumption there is that free markets are competitive, and especially that somehow the contracts and the rules of the game, the rules of society as embodied in the law, and to use the language of Milton Friedman again, are there to ensure that other people impacted by corporations, for example, customers, employees, the public as a whole, are protected somehow. That if everybody can have a contract except for the shareholders, and therefore the shareholders should be the focus of what corporations, who corporations strive to get, whatever that actually means. And again, unpacking who the shareholder is, it's as if a shareholder is somebody who only owns that one share and cares about the wealth that they get from the ownership, meaning the stock price. So all of that embodies a lot of assumptions. And when I started looking at banking, and when I emerged out of that deep dive into the banking sector and the financial crisis and what happened there and the narratives around that, I realized that especially in banking, but also more broadly, these assumptions are wrong. For one thing, because contracts are often imperfect and costly to enforce and require, a lot of, they are complicated, and there are all kinds of clauses you can think about, mandatory arbitration, or the way the legal process is costly, or monitoring to sue, or legal costs of the different sides. And because the laws are themselves a part of a political process in which corporations or certain people in the economy have a voice, and the voice, even in a democracy, it does not necessarily bubble up the most efficient set of rules. And so you can have a failure of the rules, and the failure could be a sort of feature, not a bug, of the way the rules are created and enforced. And so, the financial crisis, if you want to get into that, it really represents that kind of failure of markets, contracts, and rules. And that's not always a narrative you'd hear from the people who, prefer other narratives, but that's where you can see, what people will say and do in their own interest, if they can get away with it.
Well, I think it's an interesting way to frame it. In many ways, I agree with every word you just said. I guess in other ways, I'm not sure I agree, or we'd have to, let's dig a little deeper.
Okay.
Because I see I learned something similar, but I was different. I wasn't paying much attention to the financial sector as a non-finance economist. I always viewed finance as something over there. That was something, It was a specialized thing. It was a very specialized part of the economy. And I was very unaware of the way that the fingers of that industry reached into all kinds of places. And I also was unaware of what the failure of those firms would do to the economy as a whole. So, I like to make the analogy with the dot-com struggles at the turn of the century, when a bunch of dot-com companies that had great hopes, those hopes weren't realized. Those companies went broke. The investors lost all their money, every penny. And it was unpleasant for a bunch of people who worked in those firms, but many of them, of course, were able to find work in other firms that didn't go broke. And there was no macroeconomic consequence, at least that was measurable or widely observable or obvious, from that failure. When the financial sector had a meltdown, the whole economy seemed to collapse. People went crazy. People panicked about whether society could survive, even that people might not be able to get their cash out of their ATM machines. And it provoked a set of responses that were wildly different from the dot-com struggles. So what's the difference between the two? And one of the differences, well, you go ahead.
Well, yeah, I mean, we give that example also in the book that you interviewed me about 5 years ago. Exactly asking that question: why was the financial crisis so harmful? And in comparison to the dot-com collapse, which just to set it up more as a contrast, that dot-com collapse involved a lot more sort of paper losses, what you were just referring to, meaning the collapse in the value of certain companies, indeed their demise in many cases. In the financial crisis that started with subprime defaults, the underlying losses were actually much smaller, and yet the harm was so large. And what it is about, a lot of it was about the nature of the system, indeed the reach of the system, and the fragility and opacity of this system, the way that it controls important sort of infrastructure like the payment system related to whether your money is in the ATM, and the way it became so global and so connected, and then so incredibly fragile, and that fragility creates all these contagion processes that did not exist in the dot-com, which was just a contained system where equity values dropped. Here you had equity values dropping in a very highly indebted chain of highly indebted companies that where their counterparties really weren't quite sure how to analyze who's really sound or not, and that created many mechanisms that, in our book we call financial banking dominoes to describe it.
And so we agree on that, and we certainly agree that, I know we both agree because I've interviewed you twice and read your book, the role of leverage of borrowed money as opposed to equity. And just a quick review for listeners, in equity, you own a stock. A stock can go up really, really high, and it can go to zero. With debt, you get a fixed return, but presumably the odds of going to zero are very small. You get your money as long as the firm doesn't go bankrupt. So the idea, at least on paper, is that debt is a little bit safer, and you give up some of you give up the upside to have the lower risk of the downside. Yeah. And yet, all these firms and all these investors and all these players in this game, it lent enormous sums of money, taking enormous risks of a possible downside, knowing that the firms that they were investing in through their lending had almost no skin in the game, almost no money of their own, very little equity, which normally would mean that you'd be very nervous about giving up the upside and accepting a lower return for a smaller risk of the downside. In fact, the downside was quite likely in those cases with such small amounts of skin in the game, small amounts of own money. And when I look at that fragility that you're talking about, I notice that Wall Street went in a very short period of time from a partnership system where people spent their own money to a world where they spent other people's money. And of course, that's always fun. It's more fun to spend other people's money. But the question is, how do you get those other people to invest in you? And I think that's the question. Okay,
so let me explain. First of all, think of just basic banking, and that's really where you get from banking and then to investment banking to kind of universal banks with everything in them, the kind of big banks that we have. But even when you talk about the basic bank, which gets its funding from depositors, first and foremost, depositors are very special kinds of lenders. They don't even think of themselves as lenders. They may give. I mean, and not only that, it really gets in the banker's mind. Especially by now with deposit insurance, you can get, and I like to use that quote to kind of explain to people how ridiculous it can get. The CEO of Wells Fargo Bank, ex-CEO at the time, a couple of years ago, this is Stumpf. He said this in 2013, so shortly after our book came out. He said the following: to a reporter, we in Wells Fargo Bank, he said, we have a lot of retail deposits. Oh, he called it even self-funding by deposits. That's my money, by the way.
Yours and mine. Yeah.
And therefore, he said, now listen carefully, and therefore we don't have a lot of debt. This is what he said. Now, when I present now, I sort of put a big ha on it, like, what did you just say? You mean you forgot you owe me the money? We expect this money to be in the ATM, right? And we trust that. But he forgot he owes it because it seems to him, it feels to him like play money. It feels to him like, and the reason is that we feel safe because of deposit insurance. We do not monitor him. We do not breathe down his neck. Correct. And we are the nicest creditors in the whole economy. Even though, and we don't have any collateral, we don't have any safety there. We just have the safety of the FDIC. Now, as a result of that, what happens is in banking, banks can be, especially today with safety nets in place, they're forever, heavily indebted, although we can go back to history when they weren't before safety net as indebted. But critically, normal borrowers in the economy, especially normal other corporations, but even the kind of borrowers to which the banks themselves lend, if they become heavily indebted, they feel it. You were just saying, the interest you invest in loans, you basically start having your lenders be concerned with what you're doing with the money, with whether you can pay or not. They are going to choke you, so that companies that are very heavily indebted, end up seeking bankruptcy protection or defaulting. Now, here's what's special about banks. Banks can stay insolvent for a very long time because nobody, really calls them on it.
Nobody knows.
So this hidden insolvency, to my mind right now, I have every reason to believe that many banks are either insolvent or very close to insolvency, and nobody really knows it. And then when we panic, when we think something's wrong, then, we see who's swimming naked, in the language of Warren Buffett, when the tide goes down. So in other words, we live in this make-believe where they might even flaunt all kind of capital ratios and regulatory ratios, or, some kind of accounting number to me. But what I see is the symptom of heavy indebted and distressed. There's no companies as indebted as banks. I mean, they have single-digit equity in a good day relative to total asset, and a lot of off-balance sheet exposures that would not allow companies to actually survive in markets anywhere but banking. But they're coddled and they don't live in actual markets, which is how you can hear these ridiculous entitled things that they say, and then the somehow acceptance that that's okay for a company to live like that just because it can.
So the insolvency, just to clarify this, if it very well may be the case that there are not enough assets available for the bank to pay off its creditors, but since we're not all asking for it at once, or even close, I go in and make my $150 or $200.
We have excess deposits. Notice, by the way, that they can take the excess deposits because they always have them, because we always leave extra money in the bank, and use assets that they buy with them as collateral to get the next person to lend to them. And so you have then, on top of the deposits, a whole huge, high rise into the stratosphere of debt funding where everybody feels safe. And so that's how you get to borrow as much as banks under, you get people to lend to you, and you get to live on almost no equity. And when you make money, when you have profits, take the money out without any creditor screaming.
So one way to look at that claim you've made, which I also agree with, is that you're saying that just because everything looks okay means actually it's not. There's no reason to think that it's okay. In fact, because of the incentives in place, it's probably not okay. Which means that some bump in the road, in the case of the housing crisis, it was the unexpected drop in housing prices that forced the water to go down and people could find out who was swimming naked. But that's coming potentially in some other market, so you're worried.
Yeah, and I mean, right now you can read. I mean, I was just looking at that story and saving some of the graphs. So now we're talking about leveraged loans. I mean, if you go and look now, they're saying that there's huge, there's a lot of what's called yield chase. In the days of zero interest rates, people want to take risk. And so there is a buildup of all kinds of risk. I mean, I'm worried about cybersecurity risk, but there are other risks that come in, especially we're back to the days of what's called leveraged loans, meaning you make a loan to somebody who's heavily indebted themselves, just like subprime homeowners were, in other words, at big risk of default. And these are very opaque loans. They're not like, they overtook what's called junk bonds, actual bonds in markets that are rated and all of that. They're called leveraged loans, and then they securitize them, very similar to the way they handled subprime lending. So now we have a huge increase in that to the levels that are beginning to worry all the regulators. So if you read now, everybody's saying, this is where the risk is going to come from. I was just looking at a Bloomberg story literally before we talked, which says the title is as Fed to Oak Tree fret risks, leverage loans hit new milestone. This is just a story from October 18th, and it has various graphs, and it quotes at the end Michelle at JP Morgan Chase Asset Management, saying there's potentially overextension of cheap borrowing. That's always what seems to get the system in trouble. And here you go, just on a normal day where we're looking at midterm election or whatever else, and we're not paying attention, and here's the risk building up. Same as it was, 2006 was a wonderful year. And I often go through what the regulators were looking at and what the regulators were missing and all the measures that they were using that proved completely useless and how all of a sudden, panic hits. And if you listen to Ben Bernanke, they pulled out all the stops. So if you read Adam Tooze now, spectacular, things were done to save the system.
Yeah, well, I find those, to be honest, very depressing and a little bit offensive because what they did is they enshrined the rules of the game that were in place to help make money for those folks, and instead of questioning them, instead of forcing a reassessment of what their role was in the problem being there in the first place. And so I feel like my profession, I was going to say our profession, I don't know if we consider ourselves in the same profession, but my profession of economists, not just finance, economists, have done a great disservice to the country in saluting Bernanke and others, Geithner, Paulson, for saving the country, when in fact the mistakes that have been made along the way helped create the problem, and then to congratulate the people who started the fire for putting it out seems like a bad thing to do.
And so when Bernanke wrote his book, the title, when I only knew the title of the book before it even came out, the courage to act, this self-congratulations. And then when you hear the narratives now, they brought back, the team, Geithner and Paulson, and they were, the heroes from the bunker, but they are starting the story from when the implosion happened, and that's when they were heroes. And if you hear about the heroism, I mean, it was really unbelievable what they did to help not just U.S. institutions, but the entire, because we're the reserve currency and because there was so much exposure to, in dollar debt in Europe and there was a select set of institutions, and it was selected even politically, to whom the spigots were opened, and the Fed, beyond the government bailout themselves, TARP, etc., the Fed was just, throwing trillions and trillions of, they call liquidity to prop up a system that they've allowed to become as fragile as it was. And then, so I wrote an op-ed at the time called Where's the Courage? And it was really about the courage they didn't have before the crisis and since the crisis to really question, as you said, whether this system is okay and what can be done. They will have the story, yeah, they didn't have enough equity and we figured that out and now we have more. But I mean, the more is like the smallest tweaks that means nothing. The more is like in Martin Wolf's world, tripling zero, which is still zero. In other words, you go from nothing to a little bit more than nothing, and you call it 50% increase or triple or something like that. When you started with, I don't want to get technical into these details, but I can speak to them. You started from just an unfathomable set of standards, and you now tell me that it's stronger, which is just is not asking the question, is it the system we want? Is it as strong as it can be? Is it the right system? Does it continue to have the same ills that it had before?
So let's back up a little bit and let's talk about a couple of the things that I think are at the heart of the problem, which you may or may not agree with, but you may. So I want to hear your take on it. So the FDIC, the insurance of deposits, of course, means that I, as you pointed out, I as the depositor, as the person putting money into the bank, I don't have to worry anymore about whether the bank's going to take too much risk with my money. And that worry gets transferred onto the federal government, which gets usually implemented via various regulations restricting how risky banks can be. For the investment banks, there's no explicit FDIC, but there is an implicit bailout promise of if things get really crazy, of course, we're not going to let you lose all your money as lenders because that'll have too many ripple effects. That, of course, encourages banks to be very leveraged, to have very little skin in the game, as you point out, to have, say, 1% in equity and 99% borrowed. And then, so of course, then they say things like, so the assets.
Stuff happens.
Assets have to be safe. That's what the whole Basel set of regulations about how much AAA and weights and how much of each kind you can have. And that whole hierarchy of that infrastructure of supervision, monitoring, regulation, and implicit promise seems to me to be an utter failure. There's no reason to think that that's a good system. And I would just add, it has nothing to me to do with markets. It's not a market system. You have profits to be made and losses to be put on other people. That's just like the opposite of markets.
Yes. And
that's a destructive, inequitable, and despicable and wasteful system. And that's what we keep perpetuating.
That's right. So Martin Howig and I, who wrote a number of pieces on this, recently sought to write yet again to explain the following. The paper is called, Bank Leverage, Welfare and Regulation, and he basically says that the inefficiency of banking is fundamental to banking, and it really has to do with they always say banking has always been fragile, and to which basically we're saying banking has never been efficient. At the start, when banks were partnerships, and you mentioned partnerships, and people who wanted to kind of have that liquidity thing, like they wanted to put deposits in the bank, really demanded that the bank had 50% equity and that the owners of the banks were personally liable. It's as if Jamie Dimon had his assets would insure his deposits with his own, apartment in New York or whatever. And then, but of course, then the banks had to be very small, and they couldn't provide as much funding for the state and for everybody else, but they were the last to become even limited liability corporations, and they were even they were double and triple unlimited liability in the U.S. even through the Great Depression until the FDIC was created. So fundamentally, what you need is somebody. The lender or the collective of lenders or regulators to ensure that the bank doesn't do what it has incentives to do, which is to endanger the deposits and everybody else, and say, oops, sorry, and then there is a collateral harm. So from the problem really is that banking has never been effectively regulated, and the markets are repeatedly failing because, it's hard for it's hard for a depositor to really know what the bank is doing, going to yet another depositor and sort of increasing the risk of default. And so, we kind of delegated that to the regulators. It's just the minor problem that they keep failing at and keep maintaining a bad system. So yes, I think that Basel, the way it was coming into the crisis, was a spectacular failure, and I can just tell you how many things were wrong with it, and that what they call a major revision was really just tightening a few screws, but it really didn't improve it that much, and it remains this game of playing around with the risk weights and finding ways to increase, to kind of game it, and this whole thing, and putting it off balance sheet, and then what's called regulatory arbitrage, this cat and mouse game that continues to go, and that's because it's all so complicated and so unfocused on the right things, and it doesn't ask the big question, which is, there's no science behind it for sure. I mean, the papers that they wrote to justify it are just completely flawed, and we've been taking them on for literally a decade. But yet, they just keep saying these things. They just keep doing these things. I mean, so, you asked what I learned. I learned that there's so much of this wrong stuff, of bad policy, that can persist.
I want to go back to this issue of the role of economists and academic business professors in this kind of situation. And I'm going to be a little bit cynical. You could debate whether it's legitimate or not, the cynicism, but let me put it out here. It seems to me that everybody knows what you're talking about. I know what you're talking about. We're not alone. There's at least two of us, but I think there's a lot more than two of us that understand that there are many, many ways. I could say, well, I'd like to have a system with no bailouts and no deposit insurance, and therefore let all the costs fall on the people who make bad decisions. And that's a lovely thought. It's unlikely, but
right.
that's my
not credible.
It's not credible right now. We don't have a cultural
No, and I think it's not even good. I'm not even against deposit insurance and stuff.
Okay, so that's fine. But we all understand that given the current reality, where there is deposit insurance and where there is an implicit promise of a bailout, even when we legislate against it, by the way, we end up doing it anyway. So we had fiducia, which is a way of dealing with bankruptcies that was basically short-circuited because
corrective action,
right? Because we can't, just too risky. So that's all. That incentive is going to always be there when powerful people have a chance to be bailed out. They're going to get bailed out. So it seems to me that those of us who understand those incentives should call out and say, well, given this reality, the only way to deal with this is to have very high levels of leverage. Very low levels of leverage, very high levels of equity, which is what you've come out for.
Yep.
Now, that to me, you can debate, and I know you have, whether that's got a cost or not. I don't really care. The cost of it's small compared to the cost of the ongoing failures of the financial system that that happen and then lead to cynicism on the part of the public, correctly so, about how the system's rigged against the little person and in favor of the big person. So why isn't it the case that your colleagues and my colleagues who know this instead say Ben Bernanke did a great job, and instead of saying this whole system is corrupt. It's corrupt. It's not just like, I think we have a better policy. No, it's corrupt. It allows a group of people. You can debate whether they should have gone to jail or not. I don't think there's that much criminal activity. But what they did was shameful. They took advantage of rules that they themselves had influenced tremendously. It's not just they played by the rules of the game. They influenced the rules. They made enormous sums of money, and the people who lost money were left with enormous sums anyway. So Jimmy Kane, the CEO of Bear Stearns, he lost $1 billion, which sounds horrible, but he was left with $500 million. So it's not like he was a pauper after it was over. He was not a pauper. So the downside for these folks is glorious wealth that's beyond human imagining through most of history. And I don't understand. Well, I do. I have a theory, but I want to hear your reaction. It seems to me that our colleagues should be out there saying there's only one way to fix this that's reasonable, which is higher requirements of equity and lower allowed leverage, and get away from all this sophistication, which is a smokescreen about weights and sophisticated leverage rules. That's just nonsense.
Well, I mean, this was what I thought. So when I told you my lessons, I told you effectively my deep disappointment that some people would speak up, but many wouldn't. So when I came in, that was kind of the obvious thing I thought. It's not like it's a silver bullet. We still need to discuss all kinds of disclosure issues and derivatives and other things. And there's a lot of consumer fraud. There's a lot of other things that we can talk about, if we get to corporate governance, especially in this kind of area. But yeah, and so I wrote a paper in which I discuss, based on my many experiences engaging with people in various ways, publicly and privately, from across the system, the private sector, the policy sector, the people who did not want to engage, who did want to engage, and what I learned. The paper is called "It Takes a Village to Maintain a Dangerous Financial System." The inspiration of the title was actually from at the same time that the movie The Big Short came out, which ends with a question people want to ask. And, if you saw the New York Times 10-year anniversary business section of the Sunday of September 15th or 16th this year, it had a blank page for the 10th lesson, and it had a complete list of all the executives that went to jail, and the entire full page was blank. And it said this page intentionally blank. It was very powerful. So asked why people didn't go to jail. And of course, I'm asking about what was legal. I'm asking about, and most of what is described, even in the movie The Big Short, was legal. So nobody would go to jail for that. And so even beyond the question of fraud, which we can discuss why, Fald or other people that where there seemed to be some evidence of mortgage fraud and others, ended up just settling and moving to comfortable retirement. What was legal was most outrageous. And so then so It Takes a Village in the movie Spotlight, which came in about the same time, about sexual harassment of the Catholic Church in Boston. Sexual abuse. We're talking serious abuse, criminal abuse in the Catholic Church in Boston. And then it turned out in many other places where they were recycling these abusive priests. The lawyer tells the reporter at some point, if it takes a village to raise a child, which is a famous saying, in the title of Hillary Clinton's old book, takes a village to raise a child, it takes a village to abuse a child. And he meant people looking away, people enabling, if you think now of, Me Too or Weinstein or any kind of wrongdoing that persists, people are not speaking up. Or a lot of, in history, obviously, atrocities that persisted, with people being afraid sometimes to speak up, but all this stuff. Well, so why aren't, so I go through the enablers of the system, the enablers in the private sector, including the people inside the firms, the people around the firm, the private watchdogs, the credit rating agencies, the auditors, all of that, all the way to the policymakers, to the people in government, the politicians, and then, of course, the people who have some connection or sometimes are indistinguishable from the policymakers, like an academic like Ben Bernanke and others, and the media for, the toxic mix of confusion and sort of willful confusion. And I had to go read about, all kinds of terms in psychology about willful blindness and moral disengagement and all of those things that allow people to kind of do harm and still feel okay about themselves. And so, you've written to ethics, and it does become ethical. And, and I gave a talk here at Stanford about lessons from the crisis, in which I quoted extensively from Ken Arrow, who knew from the beginning that the crisis was a big crisis was a big point to ask a lot of questions about the very system, and indeed the very financial system with all these securities that he himself wrote about, back in the 50s. And I discovered just recently that Ken Arrow wrote an op-ed on October 15th, 2008, called Risky Businesses, saying this presents a challenge to standard economic theory. And, asymmetric information is key precisely in the complex securities that standard theory called for, which is his theory. And he knew there was a problem right back then, and he then was thinking about ethics. Well, in my ethics, in my enablers, I go to the academics and I see the kinds of things I discovered 10 years ago, which is completely false statement in a banking textbook by a big shot named, Mishkin, of all people. False statements, and then a whole slew of misleading and flawed statements and reverse engineered models, which I can go on and on about into the night, by experts, academics with clever models and all of that, to reverse engineer why somehow what we see must be good because we see it. And it's a bias that they have that, somehow what we see must be good, and a sort of cultural, sociological attempt to belong to a system because it's more convenient. And when I stepped into it, somebody said to me, when a policymaker talks to an academic, they know what answer they want to hear. So they will talk to certain academics that, tell them what they want to hear. And the academic, he said to me, wants to feel important. And so it was, I from the start sort of call it the big shotness syndrome. And, you get rewarded for providing the narratives to people who find it convenient to tell the story in a particular way, such as to start the story from their heroism of saving a system that they were very much part of and tolerated before and since, and to basically say, to us that, this system is inherently fragile and we got to put in place, the ambulances that would allow us to save it next time it implodes.
So I'm going to read a quote from your a presentation you gave recently. It starts with a quote from Upton Sinclair, and then you have a number of different applications of it. The Upton Sinclair quote: "It is difficult to get a man to understand something when his salary depends on not understanding it." Then you write, "It is difficult to get politicians to understand something, to get a politician to understand something when his campaign contribution depends on not understanding it." And my footnote to that is that, my cynicism grew after the 2012 election when Mitt Romney and Barack Obama both had a chance to campaign along some of the lines we've been talking about. They could have spoken out against the current financial system. Mitt Romney could have done it. Mitt Romney could have done it because here was his chance to show he wasn't just a rich plutocrat. He actually was going to say something that hurt his rich friends. And Obama, was coming from the left, could say it because he was going to be representing the little guy, and that would have been great. And neither one of them said a word. Not a word. It was not an issue in that campaign.
I remember that election very well because I was writing the book at the time. And, and actually, interestingly, I was following who would ever say a word. Not in the debate, not any time did it come up at all.
Should have been the single biggest issue of the campaign, in my view.
And it wasn't. Sheila Bair wrote a book right around that time screaming about this. Literally, it came. Sheila Bair's book came right before the election. There was a book by Neil Borowski about the way the bailouts went, and how much corruption there was in the way that TARP was managed, and a few other books of that sort, and of course ours trying to scream, a bunch of academics, and the academics, there were 20 academics across the board that did sign a petition that that we sent to the Financial Times, which, by the way, was moved into the letter section. The next quote you were going to, the last quote you were going to read was about the media and their incentives.
It's difficult to get a journalist to understand something when his access to news depends on not understanding.
They have access, they have ads, there's a whole layer of incentives there. And our letter was pushed into the letter section, and the next day there was a really stupid op-ed by Pandit from Citi, saying the same nonsense that we debunked on the more minor pages the day before. But anyway, what I was going to say was that at the time in 2012, interestingly, the only one who said something about the big banks and how unhealthy they are and how there would have to be something done about them was actually Paul Singer, saying that if Romney is elected, he'd have to do something about the big. This is Elliott, Vulture fund, the hedge fund guy saying, and he was one of the only people who really spoke. In 2016, there was in the Democratic Party more talk of that because you had the anger bubbling into Bernie Sanders and Elizabeth Warren and all that. And Trump was speaking about it too, only to totally fill his cabinet with the same people.
Yeah. So, my joke is that the Republicans and Democrats are the same. They both like to give money to their friends. They just have different friends. But they do have one friend in common, which is the financial sector. So they get both sides to take care of it.
Capture. And it's bipartisan opportunity too. So, you have a situation in which Senator Sherrod Brown, who's among the best on this, teamed up with the no longer, Senator David Vitter of all. And you had a Brown-Vitter proposal to end Too Big to Fail, in which before it actually said anything to do, 99 senators unanimously decided around 2013, 14, to end Too Big to Fail and end the subsidies of Too Big to Fail. They unanimous. And then Brown and Vitter had a proposal to have 15% equity for the top banks, and it never got discussed. It was bipartisan from, a Democrat and a very right-wing Republican, and they could agree on that.
So my question is, I want to restate your I want to riff on your quote. It is difficult to get an economist to understand something when his what depends on it, not understanding it. His ego, his
big shotness,
or is it his is it consulting?
I can tell you.
Is it consulting?
It's some of that, yes. I can tell you that after the original, I organized 3 multi-signatory, around 20 academics letters to Financial Times during 2010-11 before going down to write the book for a year and a half. And the second one was related to allowing the banks to pay dividends, which depletes their equity, which is just the most outrageous, really, thing you could imagine. The equity is already there, and they're paying it out. Which, anyway, I organized this, and I called. I mean, I don't want to get personal about naming the person, but I can tell you 2 conversations I had with academics. I'll suppress their names right now. One was to an academic, a very prestigious colleague. Who didn't sign the previous letter, but I thought would sign a letter that's very narrow on the payouts to shareholders, who I know agrees with it, the statement. And I said, would you sign this letter? And he said to me, well, I have some paper going with some people from Citi, I think it was. I'll get you somebody else to sign. I said, thank you, I already have people done, don't need your help. Yeah. Another one, I asked about this, who knew for sure what is going on and knew for sure we were perfectly right. I asked, would you sign this letter? And he said, well, I would frame it a little bit differently. I said, okay, so you write your own letter then. Because it was in response to some nonsense that was being said. Well, he didn't.
But we have to face the possibility.
Even right here, would hoe and hum and say perfunctory statements, but would not actually. And it was the same with the, report written by, 15 academics called the Squam Lake that was hoeing and humming and making all kinds of really, really, false, misleading statements about a lot of things that we took on in the book and elsewhere. And they wanted, their book got endorsed by Ben Bernanke because it was just like, we have these minor little general statements that don't go anywhere and don't criticize the system. And, we will only say this and not that. And it's that is not criminal, and nobody goes to jail, as you said, for that. But, the nonsense can live, or the things you don't say, don't get you into, as much trouble as challenging.
I encourage listeners to go back. We'll put a link up to it, to the episode I did with Luis Singales on the fact that economists assume everyone is self-interested except for themselves, who are, of course,
agree with him on the capture.
Yeah, we're just subjective, totally objective observers of what's good for the people in the world. Now, we do have to entertain the possibility, I think, Anat. I mean, you don't, but I do, and I think you should, that we might be wrong, that their objections are legitimate and that the system is not nearly as badly structured as we think it is. So, as you said, a statement in a textbook is wrong. There are a lot of things in textbooks that are wrong, but I think the crucial question is do the people who are not willing to go to the ramparts, to the barricades. For me, I'm just a talk show host of sorts, a podcast host I'm not in the halls of power. It is easy for me to be critical. And I've often admitted that even though I think the bailouts were a mistake and the ones that preceded it were a mistake.
I actually don't agree with that. I don't agree with that. I mean, we are agnostic about the bailouts. We just, we say you shouldn't commit to things that would, we just want to learn the lessons.
Fair enough. In which case, do you think there's a chance that the, quote, other side, the people who don't want to sign the letter, I'm not a letter signer, I probably wouldn't have signed it either, but even if I'd agreed with it, but there are a lot of people who would say, I just think that's right. I think there are better ways to get it done. I think there are better ways.
I challenged these people. I said to them, okay, so fine, you don't agree with that. I mean, I was, with staffers of the Fed when they kind of were, reluctantly kind of meeting. And it was like, okay, you don't like my solutions. Ben Bernanke said that there's a too big to fail problem. So what's your solution to it? You can tell me all day long that there is, you can find, policymakers. When they say that these companies can fail without harm, I mean, that's, that defies credibility. And so they, then I say, fine, you're saying, I'm worried they'll go to the shadow banking. I said, okay, so that whole shadow banking is a failure to enforce. So what do you propose to do? So in other words, they can sort of say unintended consequences and say all these things, but they're not proposing things to do. And by the way, about the wrong, textbook and stuff, we're talking about things that we fail students in basic corporate finance for saying. So when I challenged some of the academics, I said, okay, wait a minute. Are we teaching something wrong in the standard courses of finance, or is the banking textbook wrong? And, they would just resign from an advisory board to a trade organization clearinghouse rather than challenge bank lobbying. I mean, sometimes they just would avoid doing that. So, I'm open to engaging with anybody and take the intellectual challenge, no problem. The problem is the people just don't have real answers, and then they just walk away. So I've been very disappointed with the level of engagement of the people who disagree. They just don't engage, or they just change the subject, or they just start saying, let's go and estimate the subsidies. I'm like, why do we estimate the subsidies if we can reduce them and we agree that they're distortive, et cetera, et cetera?
So I have my essay on the crisis, Gambling with Other People's Money, is coming out in a book form in January. So I've been forced to think about these issues again, and I decided not to change anything in that book. It was written in 2010. I wrote an introduction with some of the things I've learned, but I haven't learned that much since 2010. I learned a lot between 2008 and 2010. Mm-hmm. But one of the challenges you could make of my perspective, and it's the one I've been pushing here, it's, again, very similar to yours. One of the challenges would be, well, if things are so bad, and if too big to fail is still in place, which I believe it is and you believe it is, why have we not seen another crisis in 10 years? 10 years seems like a relatively long period of time. Mm-hmm. Why hasn't this implicit safety net, which I think is at the root of the problem, why hasn't it caused another crisis? Is there one that's imminent?
I'll tell you, look, you can to me, it's really not about a crisis. To me, the system is bad every day. I mean, for example, I think the system is too bloated and, just inefficient. So it's just, it extracts from the rest of the economy for giving us the things we like. But there's reason to believe that this is not the most productive system we can have, that it just is, so it doesn't have to go into crisis to see, the crisis is when we see that it's wrong. A crisis is an inflection point. But the system is unhealthy every single day because there are loans that are made. There might be too much. There might be loans that are not made. All of these things are invisible about the distortions of this system. So I think a crisis is not, a system like this can persist for a long time, and a crisis is just when it's as if you're burning your engine driving at 200 miles an hour, and you might fall off the cliff, but you might make it along just living dangerously. So I think we just live dangerously, and we're lucky. Look, I start the presentation now by Jamie Dimon telling the Financial Crisis Inquiry Commission that he told his daughter, who was, I think, in elementary school, who asked him, Daddy, what's a financial crisis? He said to her, it's just stuff that happens every 3, 5, 7, 10 years. And so now when I talk about it, I say, it's been 10 years. So where is it going to come from? And I give these headlines, indeed, that, one is about CLO, one is about Italy, one is about cybersecurity. July 31st, 2017 Financial Times. The sequel to the financial crisis is here. Then we have, the crisis is closer than you think. You're going to have people saying the crisis is coming, and then they're going to be heroes when it does come. But people are saying that Italy political crisis hits financial crisis. This is just now, financial markets just now. So maybe it'll come from Italy, from Eurozone imploding again or something like that.
What is CLO? Is that what you said?
CLO is collateralized loan obligations, which is a close cousin of CDO, collateralized debt obligation. In finance, you often just change the names, and it's the same thing. So CLO, CDO, they're basically the same. Collateralized loan obligations, that's the leverage loans that I was discussing earlier. And so, risky debt, opaque, securitized, all of that. And, the crisis will come from somewhere we don't know, and we're going to say, oops, we didn't see it coming. But I think, again, focusing on crisis prevention alone is not really where my problem is. What I noticed, and we are now running out of time to maybe talk too much about corporate governance, is, once you have a status where you can't fail, and this is true for a lot of large corporations in other industries too, kind of the so-called too big to jail. I have only so much legal remedies when you break the law as a large corporation producing things I like. You're above the law. We can't enforce laws on corporations. So we see repeated, recidivist, corporate fraud or other bad practices, and it can cause serious harm, from opioids crisis to to pollution to other harms, and which we are having. To other violations of other laws in a corporate context. And so, going back to corporate governance, where I was 10 years ago, and back to your question from the beginning about what's changed, I now think the biggest, we have to rethink all kinds of basic things. Why are we allowing so much anonymity to shell corporations to evade the law? Why are corporations, allowed, so many rights and so few responsibilities in general? Why is there no accountability to top people? In scandals such as Wells Fargo or others, or indeed Purdue Pharmaceuticals or other, and nobody ever goes to jail who was complicit or responsible for major harm to other people. So, but for street crime, we incarcerate a huge fraction of the population. But when you're a corporate executive, you get away with a lot of things.
Yeah, I think that, that's a much bigger issue, as you pointed out. But let me raise, and it is a concern, and it's a fascinating question to me, of trade-offs of, as you say, they give us what we like, and I would say more or less. Sometimes they give us some things we don't like, and but
addictive things, right?
Well, addictive things are tougher issues for me, because I'm a big believer in personal responsibility, but. Yeah, some of those things were. But
people don't know. People didn't know how addictive opioids were.
Well, they were sold in ways where they were sold.
They hid the information. Yep. They refused the FDA. It's an information problem.
Well, we did a phenomenal interview with Sam Quinones on Dreamland, his book, and I encourage people to read that book, and I'll put a link to the episode as well. But I'm going to close with a another criticism I sometimes get of my work, and I'm curious if you agree with it and whether it applies to your work, which is, look, all these stories about what caused the crisis, the fact is people are just irrational. There's going to be bubbles in financial decision-making because people get exuberant and irrationally exuberant, and you don't need too big to fail. You don't need any of these leverage issues to explain why sometimes financial markets blow up. So don't oversell that. What's your reaction to that?
Well, I mean, you just gave the example of, the internet bubble. I actually think that, I give students during the internet bubble, I was teaching in the business school, and we were asked how come, they're worth so much without earnings, or sometimes, with tiny bit of earnings. And we did an exercise of, fortunately, we chose eBay, which is sort of still around, and to try to rationalize the huge, eBay selling for $130 with 8 cents of earnings. What does it take for growth projection and all that? And, it wasn't, it's just very sensitive to assumptions. If you project dividends to the end of time, even if they're not paying dividends for the next 10 years, what the cash flow would be in perpetuity. And people, can make mistakes about that, honestly, in terms of just assessing uncertainty for the future. So, yes, I mean, obviously, assessing the future is difficult. And, I'm from the field of finance, so I know, and I've worked on information and how it gets into prices and all of that early in my career. So I appreciate, the stories about bubbles and mistakes and all of that. But then we go back to, protecting from the unknown unknowns and how easy and obvious that is to do in the context of financial markets. They'll say, there's going to be exuberance. Well, the exuberance is in the context of these financial institutions is based on people's compensation structures, and in a chapter of our book that's called Paid to Gamble, and to your gambling with other people's money. And the last chapter is called Other People's Money, which is about governance in general, and everybody just being a little loose with other people's money and irresponsible, which is sort of a fundamental governance problem of the lack of trust. And so the issue is you can all of these things are true and may be true, and it doesn't change the fact that we don't have to suffer so much from these financial fragilities, that they are, there because a few people benefit from them and all the rest are harmed. And the markets are failing to fix that. And therefore, we need good, simple rules that would make a system kind of correct the market failures and protect us from this recklessness. And so, it's all no problem for what I'm saying.
Well, I wouldn't call it a market failure. I'd call it a government failure.
Well, I mean, it's a market failure in that you put depositors in with bankers, and the depositors, the market for the kinds of contracts that depositors want, is failing. The depositors are unable to monitor the bankers, and they, they're fragmented and dispersed, and the banker has incentives to harm them, and they get away with harming them, and the outcome is inefficient. So the last paper just said, laissez-faire banking is fundamentally inefficient, and that the government can help by creating effective commitment and taking the role of like a debt covenants for the depositors, which don't have good contracts for that. We just want to have the money in the ATM. So you can make a system more efficient when it can't kind of create the right commitments. So the issue is just the ability to commit through contracts and through markets. Markets do fail in banking. Banking is just, to create an efficient outcome, basically.
But my point is that maybe you don't agree with me, but that many of the problems that we've been talking about are the intervention of government in the reward system that would exist in a real market.
The original safety nets were meant to create stability. Okay, you created central bank to prevent pure liquidity problems from taking down a bank. Okay, pure panic. Okay, so now they have liquidity support. We enacted all these safety nets because the system was too fragile on its own. But now that we created the safety nets, we forgot to accompany them with a correction to counter the even worse incentives that that the safety net create. So my solution is, yes, you can have safety net to a point, but then you have to make an efficient, effective, counter to the incentives that get created. Some of these incentives would be there with laissez-faire, and these incentives get only worse when we try to fix the system with these interventions that you don't like. So my position is a little more nuanced therefore. I say that, to a point you want the government to, to provide certain things and certain protections, and then at the same time to not allow the abuse of those systems, and that's what what banking needs. Instead, what you have is the politics of banking only distorts it further. So and when we do. And I speak to that in my slides, which are all public, and I can send you links to a lot of them. I summarize the politics of banking, which is where the politicians see banks as a source of funding for whatever it is they like, and not a source of risk. Banks are where the money is, as the robber said. When asked why they robbed the bank, it's a kind of lame joke, but it's very deep.
It's true. It's Willie Sutton's line, and it's he was onto something.
Yep.
My guest today has been Anat Admati. Anat, thanks for being part of EconTalk.
Thank you very much. Bye-bye.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.